In this video, we will look at the differences between common stocks and coupon bonds. While stocks and bonds are frequently referenced together, there are several differences between these two types of investments. It's therefore important for you to know the distinguishing features of both in order to make correct investment decisions. Let's now look at several of these differences. Difference number 1. Stocks represent ownership, while bonds represent a lending relationship. While stocks are an equity security that represent ownership in the firm proportionate to the level of investment made, it means that when investors purchase these stocks in a firm, they're actually acquiring an ownership stake. While on the other hand, bonds are debt securities, which constitute a lending arrangement between the firm and the investor. The firm is expected to make periodic interest payments and the final repayment of the principal at the end of the life of the bond. Difference number 2. Stocks do not have a maturity date, while bonds carry a specific maturity date. Stocks do not have a defined investment time horizon. Stockholders may therefore own the stock for any period of time they desire. On the other hand, bonds do carry a defined time horizon. The bond's maturity date is actually outlined in the bond agreement. The bond does not continue beyond that maturity date. Difference number 3. Stockholders may receive periodic payments known as dividends, while bondholders receive periodic payments known as interest. Dividends, though, for stocks are not guaranteed. The directors of the firm actually make the decision on whether or not to pay cash dividends. On the other hand, bond interest amounts are known and are due at regular intervals based on the terms of the bond agreement. Difference number 4. Stocks are equity securities which provide variable returns, while bonds are generally fixed income securities which provide a known return. Returns on stocks are not predictable as stock prices fluctuate and the receipt of dividends is not guaranteed, while on the other hand, bond interest rates remain fixed throughout the life of the bond, making the amounts to be received known and the timing of those cash flows predictable. Difference number 5. Stocks have a low minimum capital requirement, while bonds carry a high minimum capital requirement. Investors in company stock may purchase units at low prices which require low capital, while on the other hand, bonds have a higher minimum capital investment requirement. It therefore means that it requires less capital to actually do investments in stocks than it does in bonds. Difference number 6. Stockholders have residual ownership, while on the other hand, bondholders have a claim to assets only to satisfy their investment holding. Stockholders have a claim to the firm's profits and assets after bondholders, preference shareholders, and other creditors have been paid. On the other hand, bondholders have only priority claim to a firm's assets ahead of stockholders in the event that the firm should go bankrupt. Difference number 7. Stockholders carry voting rights, while bondholders do not have voting rights. Stockholders can attend a firm's annual general meeting and can vote on certain issues. Bondholders, though, are not owners and they have no voting rights on any company issue. While stocks and bonds differ in many ways, there are areas in which they do share commonalities, such as stocks and bonds are both regarded as long-term investments. Secondly, stocks and bonds are both used by firms to raise capital. Third, stocks do carry a higher risk than bonds, but they both carry inherent risk. And finally, stocks and bonds provide higher returns that are commensurate to the level of risk that they entail. So, there are many differences between these two types of investments. Knowing these differences can lead you to make right financial decisions to improve your portfolio. Thanks for watching.